In this week's episode of the Stockscores Market Minutes, we're going to look at the stock market crash that is happening right now, whether it will continue, but more importantly, how to make money from it. I'll do my regular analysis of the stock, commodity, crypto markets. We're going to look at the day trade of the week on MGI. That's all coming up. So how do you make money from a stock market crash? Well, we've had a few weeks of weakness. I wouldn't call it a crash, but it has certainly been a sharp sell-off so far. And we'll do an analysis of the charts in just a moment to see whether that is going to continue. But the thing about these sharp sell-offs is they create a lot of emotion. They bring out fear among traders, and that causes volatility. There is a saying in trading, the stock market takes the stairs up and the elevator down. And we have seen certainly that downward move that has been quite sharp. Now you can make money from that by trading the inverse or volatility ETFs. So you have inverse ETFs like SDS, which is a leveraged ETF on the S&P 500. You have volatility ETFs like UVXY, which is based on the volatility index of the S&P 500 futures. Now, both of these go up when the market is going down. But then there's the other thing that crashes bring, and that is the opportunity that comes from prices being pushed too low. Now, I'm not sure that we're there yet, but if the crash continues, there will be a point where fear causes people to accept prices that are too low, and that means that there is an opportunity to buy those stocks on the bounce. And I'll show you the pattern to look for in just a moment. First, let's get into the chart of the S&P 500 over the last couple of years. And what I want you to notice is that there was these sharp sell-offs, and that led to big gains. Even short-term sell-offs where we had a couple of months of weakness led to good gains. More recently this year, in September and into October, we had a sharp sell-off, and that led to some good gains. Now, this is where we are now. Again, it's not a significant sell-off yet, but it is getting there. And if history teaches us anything, it should be that an opportunity will come from this. Now, what we're looking for when the crash has run its course is this pattern. It's called a crash reversal pattern. It's my own thing, so don't go Googling crash reversal pattern because you won't find it. But what we're looking for is a few things. First of all, a downward trend line that gets broken, a rising bottom, and a break of the downward trend line from a rising bottom. Now, I've done this on a weekly chart. The energy sector was really brutal. You can see the sharp sell-off that energy had in early 2020. And then it went sideways for a while. It built this rising bottom, and then it broke from the rising bottom and led to what has been the hottest market of 2021, and that is the energy sector. And we can use this pattern in individual stocks, but also in many time frames. If you have a stock that sells off very sharply over 3 or 4 days, you can swing trade off of something like the 15-minute chart, looking for this pattern, break of a downward trend line from a rising bottom. You can also look for it in day trades. You can look for it on very long-term time frames, like I've done with the chart Enerplus ERF, which you saw on screen there. And in that chart, again, break of the downward trend line from a rising bottom after, and that's key, after a sharp sell-off. Here is how you trade the intraday swings on some of those volatility ETFs. This is UVXY, which is my favorite. It's the most liquid. It goes up when the market goes down. And what we look for are breaks from good patterns. So here you can see UVXY made a pennant pattern and a break from a pennant pattern, and it had a nice run higher. This is a very short-term chart. That's only a 1-minute chart. So you can apply these methods whether you are a long-term trader, short-term trader, or even a day trader. The patterns work on any time frame. And if you want to learn more about those patterns, go to the trader training area of the Stockscores.com website, and we've got some videos there about all that kind of stuff. All right, let's get into the US markets now. And here is the hourly chart of the S&P 500 for the month. And you can see that volatility really picked up right there about a week and a half ago when we broke down through this upward trend line. And then we built a falling top, and then we broke down again, and we've been sliding ever lower. What we now need to do is break this downward trend line from a rising bottom. We need to watch for that crash reversal pattern. And if you see that, then we can say, okay, the market is finally going to resume that long-term upward trend. And the long-term upward trend is still intact. You can see the line that I draw here across the bottoms. We've hit it there, we hit it there. Those are our inflection points. And from that, we can draw our trend line. And as long as that trend line is intact, we are still in a bullish market. You can see that the trend line last in 2020 was broken with the COVID crash, and we had 4 sharp selling weeks as the market really crashed quite horrifically. So that's what you want to watch for. Do we actually break this line? Typically, we'll break it from a falling top. In 2020, that didn't happen. The market crashed so fast that once you broke that trend line there, you had to get out immediately, and we saw obviously the big selling pressure, but also the big opportunity that came out of the crash, which has led to significant moves higher. So the long-term trend on the S&P 500 still good. NASDAQ 100, you can see, a couple weeks of weakness, but the long-term, or call it the medium-term trend line on the daily chart, still intact. You can see that we've got some room to fall still until we get to that trend line. So we could see some more weakness next week. That would be reasonable on the tech stocks. The Russell 2000, which represents small cap stocks, really had a nice chart pattern. It broke out of a pennant pattern at the start of November and really was showing a 70% chance that it was going to go into an upward trend. Unfortunately, the overall market had other ideas. It dragged it down. So that was the 30% chance of what would happen, and it has happened. Now the question is, does it bounce? Well, this is support right about in here, which is where it is now. We are oversold on small cap stocks because we are far below the downward trend line. You can see the white space there. So if we can hold that trend line and then manage to come back up and break the downward trend, that would be great. If instead we stall here for a little bit and then break down through it, then I want everyone to be pretty cautious with the small cap sector. All right, moving on to the Canadian market, and here is the TSX 60 short term. Same story as the S&P, downward trend. Difference here, though, is we've built that rising bottom. And so if the TSX can break the downward trend line to the upside from this rising bottom, it should start the recovery process. On the weekly chart, again, the long-term upward trend line is intact. There's good reason to believe it will bounce here because it has pulling back to the trend line. So I think the S&P, the TSX, those large cap indexes look likely to bounce back next week. Will it last? Not necessarily. It's more the short-term outlook where it should bounce. We'll see if it can hold that long-term upward trend line in the weeks ahead. On the TSX Venture, which is the microcap stocks in Canada, we've also seen selling pressure, still above support, but and getting a little oversold, due for a bounce, but no sign of one yet. And so be cautious until you start to see some buyer interest come back to the TSX Venture stocks. On to currencies, US dollar hanging in there pretty well. It's in a bullish trend for the last few months, so I continue to be bullish on the US dollar. Bitcoin rallied into resistance, got stuck in resistance, and is now pulling back, but it too is approaching its upward trend line. So although it's been a pretty dismal 3 or 4 weeks for Bitcoin, it is at the point where it should bounce. Watch for that crash reversal pattern that I talked about earlier. Watch for that on the 15-minute chart, the 30-minute chart, more short-term oriented, because it should bounce in the near term. Whether it will last, we'll see. Ethereum also had a few weeks of weakness, also coming back to its upward trend line where it should reverse, and we'll see, hopefully resumes the upward trend. On to commodities, and gold has been selling off for the last 3 weeks, but not dramatically so. It is still sort of in this neutral pattern as we head sideways. We've got some rising bottoms slightly. We've also got some falling tops. So it's really a neutral pattern as we work through what's called a pennant pattern. But on the oil chart, we've had pretty strong selling pressure this month, and it was due. The oil market was overbought. Now, how do we know a market is overbought? Draw a line across the bottoms, and if you run away from that line, you're likely to pull back to the line. this up here is overbought. We are no longer overbought. We are at support where we should bounce. When the market gets down to support, it tends to bounce. Let's see if that happens. If it manages to break down through that line, well, then we need to get defensive on energy stocks. But for now, they're still okay, and I think it's quite likely that they will bounce back next week. All right, and finally, the fear chart. You see the bump up in fear, and this has been one of the ways to trade the volatility in the market. You can see volume increasing, trading UVXY, VXX. Those are those fear-related charts, and they have been doing quite well for the 4 or 5 days, but I'm not necessarily thinking it's a long-term trade. Rarely is buying the VXX a long-term trade. It just tends to spike when there's market weakness, and we can day trade it, maybe swing trade it, but that's about it. So finally then, my ratings, still bullish long-term on US and Canadian stocks, but bearish short-term. Gold, neutral on both time frames. Oil, bullish long-term and bearish short-term. Volatility continues to be high, but with pullbacks to trend lines at support on many stock and commodity indexes, we should see a bounce back in the short term. Let's watch for that next week. If there is a subsequent break of these long-term upward trend lines, then we need to get defensive, especially after the formation of a falling top. And remember, fear has risen, but that doesn't usually last very long, and we'll see if that starts to dissipate next week. All right, let's take a look at the day trade of the week. I'll explain a few extra things this week because I had some questions last week, and so let's go over this week's day trade of the week, which was MoneyGram. Really nice ascending triangle break. This is the 2-minute chart. There's the action candle. Stock goes up quite nicely, finishes the day at 5-1. The question that someone asked was, how are these numbers calculated? 1,660 shares for $100 of risk. So what I've included this week is my algorithm that calculates all that. When I put these numbers in every week, it's not just based on witchcraft. It's actually based on math that is derived from a computer algorithm that we have written. And what it's looking at is the height of the action candle to determine where the stop should be. So the difference between the close of the action candle and the low of the action candle is what we call risk. And we divide our risk tolerance, and I always use $100 of risk tolerance for these examples, into the risk of the trade to derive the number of shares. And so you can see the algorithm actually calculates this automatically. There you can see 1,660 shares for MGI. The entry point was at 11:36 on Friday, and it had 21,000 trades by the end of the day. The end of the day reward for risk was 5.5. This is all calculated by the algorithm. And if you're in my active live service, you see this. I am showing this in real time, running these algorithms for the subscribers to Active Live, and you can learn more about that on the Stockscores website. So that's how we come up with these numbers, 5.5 RR. It takes $10,342 of capital, that's where that is, and we divide that by 3 for margin, because this stock is marginable, so you only have to put up 1/3 the capital. That means $3,450 of capital. It earned a 5.5 RR gain, so for every $100 of risk, that means $550 of profit. 550 into or on 3,450 of capital is 15.9% return. You can see that it maxed out at 8 times risk. That was right up here. You can see 8 right there. Everything computer driven. None of this is, what I wish it could have been. It's all based on computer algorithms. I think that's the best way to trade, and that is how I teach. That is how I develop my tools for anyone to use, as long as they are an active trader member of Stockscores and a subscriber to Active Live. Well, I'll leave it at that. Let's see how the market pans out next week with all this volatility. Hope you found this educational and informative. If so, it would be great if you could click on the like button, leave a comment, tell me how great you think it is, anything you want to do. Hope you've enjoyed it. Trade well.